This is Radio Free Wall Street with Lee Adler, on the web at radiofreewallstreet.fm and wallstreetexaminer.com. Hi everybody, this is Radio Free Wall Street for Wednesday, March 4th, 2015. The market is pulling back, second day in a row that we've pulled back a little bit. I'm going to take a look at a couple of charts, try to get a handle on whether this pullback might have further to go and where the ultimate upside targets might be or downside targets might be. And we'll also take a look at some liquidity indicators, some economic measures. Of course, the jobs report comes this week. The federal tax collections in the week of February, during which that survey is taken, were extremely strong. The survey of private payrolls that ADP does came out today, and it was modestly higher. I think the number was 250,000. Last month's number, they had to revise up very substantially from about 213,000 to about 250,000. So they have a hard time. Both the ADP survey and the government survey has a hard time on the advance report that comes out in the month following the reference month. We shouldn't give a lot of weight to these numbers, but the market does. It always reacts, and then it doesn't pay any attention whatsoever to the revisions which follow, which are multiple. But with the withholding taxes rising as fast as they were, somewhere around 8% growth rate in early February, that would suggest that we're going to have a very strong jobs number that will probably surprise the consensus of Wall Street economists. Beige Book came out today. Nothing in there that we haven't heard before. We've been watching the data, moderate growth. There's nothing in the data that would suggest that the Fed is going to change course. The Fed's big problem isn't when to raise rates, it is how it's going to raise rates. It knows it has this problem. So the question is whether they're going to stay on track for threatening a June rate increase when they know in their heart of hearts that they really probably aren't going to be able to control short-term rates all that well with all this excess cash in the system. Last week I mentioned that I want to keep an eye out for any sign that they're going to start talking about selling assets in order to remove reserves from the system and push rates up that way. Haven't seen a word about that, so clearly that's not on the horizon yet. So I don't know whether they're going to stay on track for a mid-year rate increase or attempted rate increase or not, unless one of the Fed heads starts talking about the fact that they recognize they're going to have an issue in controlling short-term rates. Then we don't have much to go on. And the other issue is whether or not they start talking about withdrawing reserves, selling assets. If they get to that point where we start hearing them talk about selling assets, I would think that means that they're getting serious about raising rates. But with a 2.5% growth rate in GDP, I don't think they're going to be in any rush. But if the economic data starts to heat up a little bit and we start seeing plus 3%, plus 3.5%, I think that's going to put increasing pressure on them to act. Well, Greg Ip had a post today or yesterday in the Wall Street Journal talking about NASDAQ reaching the 5,000 level that it hit in 2000 when it topped out the top of the internet and tech bubble at that time. Of course, it's not the same index at all. It's not the same stocks. The few stocks that were around then that are still in the index, it's not the same weighting. Apple is 10% of the index now. Back then it was hardly anything. And Microsoft was the big dog. And there were a number of internet stocks that had significant weights that are no longer around. So it's not the same index at all. You can't really compare the PE ratio of the NASDAQ index in 2000 when half the stocks didn't have any earnings at all and were going to go bankrupt. Sure, I mean, that was maybe one of the greatest bubbles of all time. Are we in a bubble now? I don't know. What we're in is a central bank-driven fraud of a market. So I don't know if it's technically correct to call it a bubble or not. When you look at the shape of the chart, it certainly looks like virtually every other bubble that has ever formed in the past looked. So from a purely technical perspective, it sure looks like a bubble. Now, if you want to use valuations as a measuring tool for whether it's a bubble or not, be my guest, but I don't think it's relevant. I just think there's too much manipulation of earnings. The earnings per share are rising, or at least not falling, because they've been shrinking the number of shares. They're buying back stock all the time. So I just don't think that you can use valuation measures as a measure of whether or not the stock market is in a bubble, nor do I think that semantics matter all that much. As long as the central banks are driving this thing, then the market is probably going to trend higher. One of two things has to happen. Either the central banks get tired of it or start to worry and decide it's time to pull the plug, in which case I think there's going to be hell to pay, or the transmission mechanism breaks. Now, is that likely? Probably not. I don't see it in the near term. There's still a very strong correlation between the liquidity measures and the direction of the market. And until I see some sign that that's breaking, I don't see any reason to expect the market to fall out of bed as long as these liquidity measures continue to uptrend on a straight line. On the other hand, oil is a very important market. It is the money substitute for the world's wealth, and it broke. So we can't simply assume that stocks can never break as long as these central banks are pumping money into the primary dealer network so that they can manipulate stocks higher. We just can't make that assumption. We have to rely on the technical analysis and on the liquidity measures, and we have to rely on whether, as we go week to week and track this stuff, whether we see any sign, any inkling of change. And looking at the liquidity measures, and as they relate to the price measures, I don't see any sign of change. Now, in the technical measures of the stock prices themselves, the short-term projections are still from just above where we peaked last week in the low 2100s to maybe 2150, 2160. So we're still in the splitting hair zone where the market could make a run a little higher over the next month or two. Don't forget, in April, there's an enormous pay down of Treasury debt. That cash comes rolling into investor pockets, and they're prone to put some of that out into the stock market. So we'll keep an eye on April after the 15th when this cash comes in. Normally, there are pay downs for 2 or 3 weeks after that. So that second half of April, first week of May, looks like prime time for the ultimate top. But we could get sell signals earlier, so let's take a look at some of the charts and see what they're telling us. First chart I want to look at with you is my proprietary composite liquidity indicator that consists of 4 or 5 major sources of liquidity, including the Fed, some of the things that are going on with bank deposits, bank purchases of securities in various forms, and they all get various weights, and I put them together into this composite, which I've tracked since 2009. I've collected the data since then and put it all together. The blue line is the liquidity composite, and the light green line here is the S&P 500. I don't have to go into a lot of depth about the correlation. You can see it pretty clearly. And in fact, since about 2013, early in January, about 2 years ago, whenever the market has come down to the 39-week moving average of the liquidity composite on this chart, it has bounced. Here, here, here. One time it didn't. That was late last year, but then again it came down to the line in the last few weeks. We had a minor sell-off there a few weeks ago, and here again we've bounced back up to near 2100, and we've pulled back again. Same thing on the upside. The rallies on the S&P 500 have tended to come up to the level of the liquidity composite on this chart. Now, I don't know how long this is going to last. Obviously, there's 2 different scales here, but let's not ignore this correlation just because maybe we don't have a strong explanation for it. Fact is that it has worked. So up at 2100, with the liquidity composite flattening out a little bit in the last couple of weeks, that's probably temporary. There's probably reason to expect another little pullback, maybe down to the 2020, 2050 area, but there's absolutely no sign that the trend is about to break. It might be slowing imperceptibly, but there's really no reason on this basis to expect a major bear market in stocks. Another measure that I track, a component of the liquidity composite, is a measure of deposits in the U.S. banking system. that excludes any transfers that come from domestic money market funds. So it's basically newly created deposits or inflows from the rest of the world. And that is this orange line here. This chart again goes back to 2009. And once again, you can see with the blue line here representing the S&P 500, there's a very strong correlation between these deposit flows and the direction of the S&P. This measure is somewhat akin to broader money supply measures, except that it takes out the transfers between money market funds and bank deposits. But you can see this has gone to another new high here. Stock prices followed. Again, quite a strong correlation. So as long as we have this measure of growing deposits and inflows from other sources around the world into U.S. bank deposits, this would be another measure that, unless it shows signs of moderating, there's probably no reason to expect a major downturn in stock prices. Obviously, this isn't the only indicator I pay attention to, but it's just another arrow in the quiver that we watch to kind of keep us on track on this thing. Again, this is a manipulated market, central bank and liquidity driven, and we need to pay attention to these indicators, and whether we like it or not, this is the way the world works today. So we've got the jobs report coming out on Friday, and I can't forecast what the number will be, but I can get a handle on whether or not the market is going to miss or beat the Wall Street consensus based on where these estimates are and whether or not the withholding tax collections for the period of the survey were strong or not so strong. And the survey is taken the week of the 12th calendar day of the month. So here we are in February around the 12th. And while there was a little dip in here, say around the 10th, these numbers were running pretty strong. This is with the holding tax collections, the rate of change on an annual basis adjusted for the rate of change in wages. So this is a measure of real change in the withholding taxes. On a 30-day average basis, which would cover the whole month, the real rate of change is running close to 5% here at the end of February. And towards the early part of the month, it was closer to 7%. So that's just a blockbuster number. So I would expect that, if anything, the jobs number is going to surprise on the upside. And if it does, if this projection turns out to be correct, obviously that's an element that might put the Fed under additional pressure to begin to fake that they're going to raise interest rates. And that'll be destabilizing for the market. We could see some shakiness. That could coincide with a period where liquidity is a little bit tight. In March, in the rest of March, we get quite a bit of new Treasury supply hitting the market. So that will add some supply pressure, and maybe that'll tie in with a strong jobs number where we could see Treasury prices come under some pressure. Let's take a look at a chart of the Treasury market. This is a weekly chart, a weekly bar chart of the 10-year Treasury yield with cycle channels superimposed. You can see that we've come up very sharply in rates since they got down here in the 170, 180 area on the 10-year earlier this year. And now we're back above the critical 208 level, which was an important trend resistance level and a flat resistance level. So we're back above that. And there's another trend line. I'm going to zoom in here. So there's another critical area in here, right about 215, where the peak was a couple of weeks ago. If the market closes this week above that, that would indicate a significant reversal and would suggest that the market could make a move to, say, up here around the 235 level, maybe 240. And I think that would be a serious reversal. You can see the 12-month cycle momentum has already gone to triggered an upside signal, which in this case would be a sell signal. On the other hand, if for some reason yields reverse and close back below 208 right in this area here, then the downtrend would still be in force. But I think any movement above the 215 area would be another indication that we have a major cyclical reversal underway. And wouldn't it be interesting, because it's a higher low versus the 2012 low? Everybody's been saying, oh, we're still in a secular downtrend, but I'm not so sure. We've had a higher high versus here, and now we have the possibility of a higher low. It's still more or less range bound on the bigger cycle picture, say between 165 and 290, but that's a big range. So we're halfway up in that range now. If we get past that, then there's always the possibility that we could head back towards 3% by the latter part of this year. I think we're at a critical point here. The next couple of weeks are going to be real interesting. We'll keep a close watch on this 10-year Treasury yield over the next couple of weeks to kind of give us a handle on where it's then likely to be headed. Taking a look at the long-term chart of the S&P 500, this is a weekly bar chart. I've zoomed in on it. You can't see the ticks, but this line here is the beginning of this year, and this is the beginning of 2014, 2013. So I've zoomed in from about the middle of 2012 up until just the last week. Today we closed just under 2100, right around here. Now this trend line goes back to the 2011 low. We broke it in the middle of last year, and since then we've kind of been oscillating around it, and we're kind of honing in. It's sort of become a regression to the mean situation right here at around 2100. So we'll oscillate around here. If we stay below this trend line connecting the highs and start to roll over, that could be all she wrote for now. But again, before we get anything going on the downside, we've got to break this trend line, which comes in at just about 2075. And then we would have to break this low, which comes in at roughly 1975. Now, from where we are now to 1975, think about it, that's only a 5 or 6% decline. And we're not used to those 5 or 6% declines. When are we going to get a normal 10% correction? Well, I don't know. Remember, the ECB is going to tell us very soon exactly how much of what kind of paper they're going to be buying every month. And those purchases should start in March unless they change the program. So that's going to add to the pot, depending, again, on what the banks do with the cash. Don't forget, they've got a tremendous pile of loans that they've taken from the ECB. And if they don't see opportunities to deploy and they don't want to buy treasuries that are yielding only around 2%, they might elect to pay down some of those loans from the ECB, which won't help the markets at all. And that would leave the Bank of Japan as the only player actually pumping funds into the market that are making it to the market. So we're going to keep an eye on the ECB and see how that balance sheet behaves, particularly through the rest of March. But for now, it looks to me like we're going to get stuck in this trading range again. We might, over the next couple weeks, come down to maybe the 2025 area, depending on how long it takes, maybe 2050. But really, in order to have any sense that we're going to get something going on the downside, we got to come down, break 2075, break 2050, break 2000. All of these are support levels, and each time we get to one of these support levels, we're likely to see another bounce. So it's going to be very frustrating. I'd like nothing more than to tell you that I see a definitive signal in this market, but it's just not there. I will say this. The market looks extended. The momentum indicators are weakening. Like if we look at, for example, the 3-year cycle oscillator here, it topped out in 2014. But it's indicating a down phase, but it's a barely perceptible loss of momentum. This line would have to turn down much more sharply to indicate that this down phase in the 3-year cycle is actually going to manifest a negative slope in prices. Otherwise, prices are just going to continue to slowly trend higher. The long-term trend channels are absolutely intact. The market is in the upper half of that channel. The mid part of the channel now seems to be somewhere around, let's say the mid part of the channel is right about there. So again, that looks like 2050, 2075. I think that's a crucial level to look at on this pullback, assuming it gets that low. And if the market bounces hard from there, then we don't see any downside. But if it looks a little soft, a little mushy as it gets down there, then we look at these 25 to 50 point increments on the downside. And once we break through that and ultimately We got to get below 1950 to signal a bear market, or say at least 1975. That's where these two lows are here. Say around 1980, 1975. If we don't get below those, then we're not going down. That's all there is to it. So that's all I got for you today. We'll get together again next week on Wednesday, as usual. That'll be Wednesday, March 11th. Until then, have a great week. Trade sane. I'll see you next week.